Tonight didn't start with a headline. It started with a sentence that most people won't even notice until it's too late. Because on Thursday morning at 9:37 in Beijing, a press room went quiet, a deputy governor stepped up, and in 11 minutes, China lit a match under the global money system. Not missiles, not troops, gold. And if you think that sounds dramatic, wait until you hear the exact move they just offered the world and why it targets the US dollar in the one place it can't defend. Now, real quick, if you value original work on YouTube, support me for a second. Subscribe and drop OG John AG in the comments so I know you're here for the real thing, not the copycats. All right, let's jump in because this isn't another news cycle. This is the opening round of a reserve currency fight. China's central bank released an English translation at the same time as the domestic announcement. It was short, it was clean, it was written like boring bureaucracy, and that's exactly why it's dangerous. Buried inside the routine language was one offer. Foreign central banks and sovereign wealth funds can store gold inside Shanghai-based vaults, settle the fees and the transactions in renminbi, and get guarantees that are meant to look as strong as the traditional Western standard. If you're not in the weeds of this stuff, that might sound like a simple storage upgrade, but it's not. It's a doorway. A doorway for countries to move their gold out of New York and London, reduce their dollar exposure, and conduct official reserve activity inside China's financial plumbing. And the moment enough countries take that doorway, the dollar's network effect starts to crack. Now, before we go deeper, check the description. I've dropped bonus links there for you. Yes, including the premium WhatsApp channel link and the channel membership option. If you want the extra updates without hunting for them, that's where they are. So here's the key question. Why would anyone move their gold? Because in 2022, the West proved a point to every central bank on the planet. Reserves stored in Western jurisdictions can be frozen, blocked, or politically weaponized. That event didn't just scare Russia, it scared everyone watching. And central bankers don't react with emotion. They react with math and risk. So China's pitch is simple. Bring your gold here and we'll build you a safer lane. Now, I want to make sense of what China built, why it matters, and what it could trigger next. And then, once we've got the mechanics clear, I'll walk you through a timeline, month by month, of how this type of shift can snowball, how markets tend to react, and what it means for normal people holding assets priced in dollars. Because the World War part isn't about tanks. It's about who controls settlement. It's about who controls storage. And it's about who controls the rules when something goes wrong. Now, China's Shanghai vault system didn't appear overnight. By multiple reports and industry chatter, this has been years in the making. Facilities, legal structures, insurance arrangements, audit procedures, transport relationships, the whole stack. And the first thing you need to understand is capacity. If you're building a vault just for domestic use, you size it for domestic needs. If you're building a vault to attract foreign central banks, you size it like you're trying to compete with London and New York. That's what this looks like. The facility is described as multiple underground vaults, designed to handle allocated holdings, meaning specific bars, identified by serial numbers, held as segregated property. That allocated word is not a vibe, it's the entire game, because the Western gold ecosystem has two faces. One face is real, physical metal in a named account. The other face is paper claims, unallocated pools and layered contracts where ownership can be fuzzy and rehypothecation risk lives in the shadows. When China says allocated, segregated bar by bar, they're signaling, we can give you the things some people worry they're not fully getting elsewhere. And you can see why that message lands. Now, China didn't stop at storage. The promise includes insurance coverage. And not just, we'll take care of it, but structured insurance language that tries to neutralize the biggest fear after 2022. Political seizure. They're basically saying, even if something gets ugly, we've built protections that look comparable to established standards. Is it perfect? No system is perfect. But the goal isn't perfection. The goal is to make Shanghai feel like a legitimate alternative venue in the minds of reserve managers. Then comes auditing. If you're a sovereign entity moving billions of dollars of metal, you don't just want a spreadsheet and a smile. You want third-party verification. China's pitch includes independent audits, physical counts, weight checks, purity confirmation, the boring stuff that becomes extremely exciting when trust is the currency. And finally, repatriation. This is the part most people don't talk about, but central banks absolutely do. Because storing gold in a foreign vault is only as good as your ability to get it back on demand. China's offer includes delivery rights with a defined timeline. And they know exactly why that matters, because the world remembers past repatriation debates and the uncomfortable questions they created. So when you add it up, allocated structure, insurance posture, audit access, and repatriation language, China is trying to say, we can do the whole Western package, but inside our system. And then comes the real weapon, the settlement currency. Because China isn't just offering storage for gold. China is offering a financial rail. Fees, contracts, swaps, credit lines, settled in renminbi, with gold sitting right there in Shanghai as collateral, as liquidity, as proof of seriousness. That's how you create an alternative reserve ecosystem without declaring a formal gold standard. And that's why this is not a vault story. It's a reserve story. It's a payment story. It's a network story. Now, let's talk network effect, because this is where people get confused. The dollar is not dominant simply because the US is big. The dollar is dominant because the world uses it. If you're a country trading commodities, settling invoices, rolling debts, managing reserves, you default to dollars because everyone else defaults to dollars. That self-reinforcing loop is the moat. But moats can drain. If enough big players start doing more trade and more reserves in another unit, the loop weakens. Not overnight, not in a single headline, but slowly and then suddenly. That slowly then suddenly is the pattern that traps people. Now, China also has another advantage, preparation. They've been accumulating gold for years, and they've been building bilateral trade links that reduce dollar usage, especially across the commodity chain. So when they announce a vault and settlement option, it's not a standalone move. It's a capstone on a long strategy. Make renminbi more usable, more acceptable, more infrastructure-backed. Now here's the part that makes markets twitch. The moment even a handful of central banks begin exploratory discussions about moving gold, everyone else watches. Because reserve managers don't want to be last. They don't want to be the country still storing most of its metal in a jurisdiction that could turn hostile. They don't want to be holding a currency unit that's losing share if a shift accelerates. So they hedge, they test, they diversify just in case. And once diversification begins at scale, it becomes a trend. Now you've probably heard numbers thrown around about China's gold holdings. Officially, China reports one number. But analysts often argue the real exposure is larger when you include state-connected entities and strategic accumulation outside the headline figure. I'm not going to pretend we know the exact number. What matters is the direction and the intent. China wants to be seen as gold serious. China wants gold to be culturally embedded domestically. China wants gold to be a reserve-adjacent asset globally. And the vault offer is designed to turn that desire into a service. Now, step back and ask, why would a central bank care about renminbi settlement? Because settlement isn't just how you pay. Settlement is control. If your trade, your swaps, your hedges, and your storage costs run through dollars, you are attached to the dollar system. You are attached to dollar liquidity. You are attached to dollar sanctions risk. You are attached to U.S. monetary policy, whether you like it or not. But if you can settle a chunk of that activity in renminbi, with gold parked in Shanghai as a neutral-ish collateral base, you are building optionality. Optionality is power. Now, I want you to notice something. China didn't say, we will replace the dollar tomorrow. They didn't need to. They just offered an alternative lane, with enough credibility that real institutions might actually use it. And that's the only thing required to start the shift. Now, here's where the mainstream financial media tends to mess this up. They'll frame this as a symbolic move. They'll say it's limited impact. They'll say the dollar is too big to fail. And in a narrow sense, they're right. Big systems don't flip in a week. But that's also why they're wrong. Because reserve systems don't collapse in a week. They erode. They leak. They lose share until one day, the confidence that held it together snaps. And when confidence snaps, the repricing is brutal. Now, I'm going to map out a plausible cascade, not because I can see the future, but because this is how institutional behavior tends to work when risk perception changes. And as we go through it, I want you to keep one thought in your head. The dollar's status is not a law of physics. It's a social agreement backed by infrastructure. China is building infrastructure. Now, here's the first stage. Stage one is quiet discussions. A few countries, often commodity-linked, often geopolitically diversified, open dialogues. They ask about logistics. They ask about legal protections. They ask about insurance. They ask what happens if relations sour. These early movers don't need to move everything. They just need to signal they are willing to. That alone changes incentives. Then, stage two. Stage two is pilot transfers. A smaller central bank moves a portion, enough to test the process, enough to learn the paperwork, enough to see how markets react. If that transfer goes smoothly, the next country feels safer. If the next country feels safer, the next one moves. And that's when you get stage three. Stage three is headline transfers. A big player does it. And the biggest potential headline transfer is a commodity heavyweight, because that ties storage to trade. Oil is the obvious example. If a major energy exporter publicly aligns storage, settlement, and trade experimentation with China, markets read it as a long-term pivot. And once markets read pivot, they price trend. That's when you get volatility. Now, at this stage, what happens to the dollar? It doesn't vanish. It gets hit where it's vulnerable. Marginal demand. Reserve currencies survive on steady, ongoing foreign demand for their debt and their liquidity. If foreign institutions reduce marginal buying of dollar assets, yields rise. If yields rise, borrowing becomes more expensive. If borrowing becomes more expensive for a government that already runs huge deficits, the pressure increases. And here's the trap. The system can respond by tightening, which breaks growth, or by easing, which breaks confidence. Either way, it's pain. Now, let's talk about the scale of foreign dollar exposure. Foreign central banks and global investors hold a massive amount of dollar-denominated assets. Treasuries, deposits, bonds, equities, the whole pile. Those holdings exist because of reserve status. They exist because dollars are useful everywhere. But if a competing lane grows, those holdings begin to diversify. And diversification, at scale, is selling pressure. Selling pressure doesn't have to be panic to matter. Even a slow, consistent reduction of exposure changes pricing over time. Now, imagine a world where the dollar share of global reserves slides a few percentage points per year. At first, nobody cares. Then suddenly, everyone cares. Because when you cross psychological thresholds, behavior changes. The big psychological threshold is the moment the dollar is no longer clearly dominant. At that point, managers act differently. They stop thinking default and start thinking portfolio. And once you become portfolio, you become replaceable. Now, the personal consequences of reserve erosion are not abstract. If your entire financial life is denominated in a currency that is losing external demand, you face higher import costs, higher inflation pressure, and higher interest rates. Even if your income stays the same, your purchasing power falls. That's why reserve status matters to ordinary people. It subsidizes borrowing. It stabilizes the currency. It makes imports cheaper. It makes the whole lifestyle easier. So when it erodes, the lifestyle erodes. Now, here's the part that makes people uncomfortable. If policymakers try to defend the currency by keeping rates high, debt servicing becomes a monster. If they try to defend growth by cutting rates and printing, the currency weakens and inflation can accelerate. Either choice forces trade-offs. And the more debt a system carries, the uglier those trade-offs become. Now, I'm going to walk through a possible month-by-month sequence. Again, not prophecy, but a realistic chain reaction based on how institutions tend to move when incentives shift. And as I do it, I want you to ask yourself, if you were running a central bank, would you wait until everyone else moved first? Or would you want at least a small seat in the new lane, just in case? January. Announcement and early whispers. Most markets shrug. A few countries call, quietly. Two things happen behind the scenes. Lawyers read the terms, and logistics teams map the routes. February. First pilot transfer. A mid-sized central bank moves a portion. The move isn't huge, but it's symbolic because it proves the lane works. Gold market people notice first, then currency traders. March. A bigger headline. A commodity-linked country makes it public that they're exploring storage and settlement options. Maybe the language is diversification. Maybe it's risk management. But everyone understands the real message. Dollar index dips, gold rips, bond yields twitch. April. Regional blocs coordinate. Southeast Asia is an obvious candidate because regional coordination amplifies bargaining power and reduces political risk. If multiple countries move together, it looks less like a one-off and more like a shift. May. The BRICS narrative ramps. Even if BRICS is messy and politically complicated, the symbolism is powerful. Markets don't price perfect coordination. They price direction. June. A big surprise. This is the month where an ally of the U.S. could do a pilot, not because they're anti-American, but because they're pro-survival. This is the move that would break the mental barrier. Because if allies diversify into the alternative lane becomes normalized. July. Policy response. The U.S. reacts not with speeches, but with liquidity tools. Officials talk about confidence, stability, and strength. Markets listen less to words and more to flows. If rates are cut, the dollar can weaken. If rates are held, debt stress grows. Either path creates volatility. August. Acceleration. Once investors feel the policy response is limited, the focus shifts to inflation and purchasing power. That's when people rush for hedges. Hard assets move. Commodities move. Real estate in some areas moves. And the average person starts feeling it through prices. Now, I want to pause here and make it practical. If you're watching this and you're successful, Maybe you've built wealth, maybe you've positioned well, maybe you've made moves that worked. Share your success story in the comments, not to flex, to help other people think, because your experience might be the exact spark someone else needs. Now you might be thinking, okay, John, what do I do with this? First, don't panic. Second, don't ignore it. Third, understand your exposure. If your savings, investments, and future plans are 100% dependent on one unit, you're vulnerable to that unit's repricing. Diversification is not fear. Diversification is policy. Now, I'm not telling you to do anything reckless. I'm telling you to think like the people who run reserves. They never bet on one path. They hold options. Now let's talk about assets for a second. In a world where reserve dynamics shift, you typically see pressure on long-duration bonds because bondholders need confidence in the currency. You often see volatility in equities because earnings might rise nominally but fall in real terms if inflation outruns growth. You often see increased interest in commodities and hard assets as hedges, and you often see people chasing narratives, which creates bubbles in weird places. So the goal isn't predict every move. The goal is build resilience. Now, let's zoom back to the vault system, because one of the clever things China is doing is offering the feel of Western protections while embedding the operational reality inside their ecosystem. Allocated storage is the bait. Insurance is the comfort. Audits are the credibility. Repatriation is the escape hatch. Settlement in renminbi is the capture. Because once you settle a growing share of official flows in renminbi, you also grow renminbi liquidity. And once renminbi liquidity grows, the currency becomes more usable. And once the currency becomes more usable, more trade can move to it. And then the circle tightens. That is how you build a reserve contender, not by announcing it, by building it. Now here's a subtle point. China does not need to fully back the renminbi with gold at a fixed price. They don't want that constraint. What they want is an implicit linkage. If you hold our unit, you can access gold in our venue. That makes the unit feel sturdier than pure paper, without forcing convertibility. It's clever, it's flexible, and it's exactly the kind of middle path that can attract cautious institutions. Now you may ask, why would anyone trust China? They don't have to trust China more than they trust the West. They just have to trust China enough to hold a slice. And once that slice becomes normal, the slice becomes a trend. Now let me bring this down to the human level again. What hits you first in this kind of shift is not a headline about reserve status. It's price creep. It's the same groceries costing more. It's the same car costing more. It's rent pressure. It's insurance pressure. It's interest rates that don't behave the way people expect. It's the feeling that money works less. Now, if that's already how it feels, then you understand why this topic matters. Because a reserve shift accelerates those pressures. It raises import costs, it raises commodity costs in local terms, and it creates the conditions for policy responses that make everyone angry. Now, one more thing that most people miss. When a reserve system changes, the wealth transfer is massive. Savers holding cash suffer if inflation rises. Bondholders suffer if yields rise. Debtors with fixed-rate loans can actually benefit because they repay in weaker currency. Owners of scarce assets often see nominal values rise. So the system doesn't hurt everyone equally. It reshuffles winners and losers. That's why positioning matters. Now, I'm going to give you a simple framework. 1. Emergency fund. Keep it. 2. Debt structure. Understand it. Fixed-rate debt behaves differently than variable rate. 3. Asset mix. Don't be 100% dependent on one scenario. 4. Income resilience. Skills and cash flow matter more than paper returns in unstable environments. 5. Optionality. Have moves you can make quickly if conditions change. Now, I'm not here to sell you fear. I'm here to translate what institutions are doing into language normal people can use. And institutions are obsessed with one word right now: diversification. Now, friendly reminder again, check the description for the bonus links, including the premium WhatsApp channel and membership. I keep those there so you don't have to dig. And speaking of membership, we're also offering members-only videos where a separate team goes deeper. More research, more sourcing, more detail. Content that's designed for people who want the extra layer. That's for premium members, and the link is in the description too. Now, I promised you retention, so here's the cliffhanger you need to sit with. The vault story is not the end, it's the start. Because once you build a golden settlement lane, you can attach other things to it. You can attach trade settlement agreements, you can attach commodity contracts, you can attach swap lines, you can attach digital settlement tech. And then you don't just store gold, you become the hub for pricing. Now, imagine a world where more commodity trade is invoiced and settled outside dollars. Even if it's 10%, even if it's 15%, that alone changes dollar demand globally. Now, we've talked about how this pressures bonds, but what about stocks? Well, stocks are tricky. Some companies can pass higher costs on to customers, some can't. Some earn globally and benefit from weaker local currency. Some depend on imports and get crushed. That's why this environment produces big winners and big losers, not the market as one blob. Now, here's what I want to ask you. If you were running a central bank and you saw a credible alternative lane being built, would you move 0% of your gold? Or would you move 5% just to hedge the risk? Drop your answer below. Because the crowd is usually smarter than any single person, and I want to see where you think this goes. Now, let's talk about the psychological side. When people feel systems are changing, they overreact to the first signals. Then they underreact to the next ones. Then they panic late. That's the pattern. So the goal is not to panic early or panic late. It's to position early. Now, I also want to do something a little creative right here. If you're into silver-related success stories, real people, real wins, what they did, how they did it, there's a link in the description to another channel you can check out. Subscribe over there too and see how people have been stacking and building over time. Now, back to our story. There's another piece here that matters: credibility through standards. China mentioned equivalence to establish standards. That's not just marketing. It's a signal to institutions. We can meet your compliance needs. We can meet your audit needs. We can meet your governance needs. Because central banks don't care about vibes. They care about policy frameworks. If China can provide enough legal scaffolding to satisfy boards and committees, then the move becomes allowable. Once it's allowable, it becomes possible. Once it's possible, it becomes likely. Now, you might be thinking, but isn't the dollar still dominant in payments? Yes, and that dominance is exactly why change can be slow. But slow change is still change. And the trend, not the snapshot, is what matters. What matters is where the direction points. Now, let's connect this to the most important real-world lever: borrowing costs. If foreign demand for treasuries weakens, yields rise unless the central bank buys. If the central bank buys, that's monetary expansion. Monetary expansion in a supply-constrained world often translates into higher inflation pressure, so the system is boxed. Now, some people say, well, the US can just outgrow it. Growth helps, but debt is the anchor, and the larger the debt pile, the more sensitive the system becomes to interest rates. That's why reserve status is so valuable. It keeps financing cheap. It keeps the anchor lighter. Now, if you feel like this is too big to wrap your head around, remember, huge systems often turn on small margin changes. You don't need every country to sell dollars. You need enough marginal demand to weaken. Then prices adjust. Then behavior changes. Then the adjustment accelerates. Now, let's get extremely practical. If you're holding long-duration bonds because that's what safe investors do, you need to understand duration risk. When yields rise, long bonds get hit hard. That's basic math. If inflation expectations rise, long bonds can also get hit. So safe becomes fragile. Now, if you're holding all your savings in cash, inflation is the silent tax. Even if you never lose a dollar, you lose purchasing power. Now, that doesn't mean you go all in on one hedge. It means you build a mix: hard assets, commodity exposure, inflation-protected structures, real cash flow businesses, skills, optionality. Now, let me add another engagement point. If you've ever made a move that protected you during inflation, maybe you locked a fixed-rate loan, maybe you bought an asset that held value, tell us in the comments what worked for you, because that knowledge is more valuable than any generic advice. Now, I want to circle back and address the war language, because people will say, John, why call it war? Because reserve currency competition is not friendly. It's power. The reserve currency sets the rules. It gets the demand. It funds its deficits more easily. It exports inflation. It controls settlement. So when a rival builds a parallel lane with gold at the center, it's a challenge to power. That's why it's war, financial war. Now, do I think this ends the dollar tomorrow? No. But do I think the direction is clear? Yes. And do I think most people will react late? Absolutely. Because people are trained to believe the status quo is permanent. It's not. Now, here's another cliffhanger. If Shanghai becomes a major gold hub for sovereigns, what happens to London's role? What happens to New York's prestige? What happens to the pricing power embedded in those markets? Because control of the hub often translates into influence over the benchmark. And influence over the benchmark translates into leverage. Now, imagine a future where the center of bullion settlement slowly migrates eastward. That wouldn't just be a financial change. It would be a geopolitical shift. It would affect alliances. It would affect sanctions. It would affect how countries think about risk. Now, I'm going to give you a simple watch list so you can track this without living on financial Twitter. Watch for public pilot transfers. Watch for language about allocated and segregated storage. Watch for renminbi-denominated commodity settlement headlines. Watch for bilateral swap lines expanding. Watch for reserve composition changes in official reports. Watch for bond yield spikes that don't match domestic growth. And watch for rhetoric about liquidity support and emergency facilities, because those are the tools used when markets stress. Now, one more time, subscribe, because this channel is going to track this in plain language without the fluff. And if you're watching and you haven't subscribed yet, my stats usually show a ton of viewers who watch but don't subscribe. If that's you, fix it right now. Subscribe so you don't miss the next update. Now let me hit one more angle that people keep missing, because this is where the dominoes turn into real-life stress. When reserve status weakens, it doesn't just hit markets, it hits wages. Most salaries don't reprice as fast as groceries. Most contracts don't adjust instantly. So even if you're fine on paper, your day-to-day can feel tighter month after month, and that's how social pressure builds. That's also why governments respond with more spending, more subsidies, more stimulus. And that can feed the very inflation problem they're trying to solve. And here's the sneaky part. This kind of shift can make the numbers look good while life gets worse. Your house might be worth more, but so is the mortgage rate if you need to move. Your portfolio might be up, but the currency buys less. Your business might show higher revenue, but the costs eat the margins. That's why I keep saying, don't stare at nominal gains. Track purchasing power. Now, if you're a metals person, this is where gold and silver stop being a trade and start being an insurance policy. Gold tends to act like monetary protection when confidence cracks. Silver can be more volatile, but it also reacts hard when the market starts pricing scarcity and currency stress. And I'm not telling you to chase a spike. I'm telling you to think about what happens if the world starts valuing neutral assets again. And watch the timing. These shifts often start quietly in official channels, and then they show up suddenly in retail behavior, like coin premiums, delivery delays, and weird gaps between paper pricing and physical availability. When you see those gaps, that's the market telling you something important. So here's the cliffhanger. The first place you'll see the next phase won't be a press conference. It'll be a trade invoice. It'll be an oil contract. It'll be a swap line headline at 2 a.m. And when you see that, you'll know the vault move wasn't a headline. It was a launch. One more reminder. If you're winning right now, if you've built a cash flow stream, paid off toxic debt, stacked hard assets, or simply made better decisions than you used to, tell your story in the comments. People learn faster from real examples than from theory. And if you want me to break down these signals in real time, that's exactly what the premium WhatsApp channel is for. Quick notes, key charts, and the stuff that doesn't fit inside a single YouTube upload. It's in the description. Same with membership, because members keep this channel independent when the narratives get loud, and they unlock the deeper members-only research drops. So if you want that edge, join today and stay ahead now. Now, as we wrap, I want to underline the core message. China offered the world a new lane, a lane where gold can be stored, audited, insured, and moved, while settlement happens in renminbi. That's not a press release, that's infrastructure. And infrastructure changes behavior. Behavior changes flows. Flows change prices. Prices change politics. Now, you don't have to become a full-time macro analyst to protect yourself, but you do have to stop pretending nothing changes. Build options. Reduce single-point failure. Keep learning. Now, here are 2 questions I want you to answer below. First, do you think major central banks will actually move meaningful gold to Shanghai, or is this all posturing? Second, if you had to hedge one thing right now, currency risk, inflation risk, or interest rate risk, which one would you prioritize and why? Drop your answers, and if you've got a success story, big or small, share it so others can learn. And again, bonus links are in the description, including the premium WhatsApp channel and membership options, plus members-only videos for premium supporters. With that said, take care of yourselves, take care of each other, and I'll see you in the next one.